Hello everyone, Mehdi Photocall for mine. So today we are going to talk about a concept in investing which is very important, and this is the setup. So what is the setup? The setup is the moment and the environment to invest in one stock, meaning that how the stock has performed before and what are the expectations with the stock going forward. And so why is it important? Well, there are a few reasons, but let's start with a very broad overview of why the setup is very important. So the setup is important because it's determined like all the expectations from investors about the stocks. And if you start with very high expectations, it's going to be very hard first to deliver against these expectations. And second, it's going to also be very hard to actually have significant returns because everything is already priced into the stock price. And so that's why trying to invest in very good setup where expectations is very low and where a lot of investors are not expecting a lot of returns going forward from a stock is going to give you outperformance and is going to actually bring significant money and profit for your portfolio. So how do you analyze a setup for a stock? So first, there is the valuation part. Obviously, just for beginners, just a quick recap of the main valuation metrics that we are looking at. So P ratio, price to operating cash flow, price to free cash flow, for example. For some companies, we're also looking at price to book, mainly for banks, for example. So this valuation part needs to be adapted for the company and the industry you're looking at, obviously. So this actually takes experience to understand what means valuation for a certain type of stock. But having said that, there are a lot of stocks which are obviously either very overvalued or very undervalued. And so that constitutes one part of the setup, meaning that being overvalued means a lot of expectations, and a lot of investors expect a lot of things to happen and to happen very well in the future. And undervaluation basically means that investors, they don't expect much from the stock, and that's why they don't value it as much. So these expectations actually exist in a lot of different aspects of the business. So this can be, for example, in terms of growth. So having a good setup is basically having very low expectation in terms of growth, but in reality, growth is going to reaccelerate for some reasons. We can see that, for example, in companies like, let's say, for example, PayPal. So PayPal is being left for dead, basically. But with the new CEO, they're definitely going to have a new pathway to growth, and especially to profitable growth. And so this is going to bring new delivery against the revenue and against the bottom line, which is going to surprise investors. So that's a good setup. What is a bad setup? A bad setup is, for example, for Palantir. So within the stock price of Palantir, there is a lot of growth already baked in. So meaning that investors, they are expecting Palantir to grow at more than 40% per year over the next 5 or even 10 years. So let's say that this actually plays out this well for Palantir. Well, in this case, you're not going to see much returns because everything is already priced into the price. So you've already made the return so far. And so if you're late to the game, you're not going to make any return. But the worst case scenario is that there is some kind of disappointment from investors and Palantir grows only at 30%, for example, or even worse, 20% in the next 5 to 10 years. And so what's going to happen? Well, the stock is going to reprice. And when the stock reprice, it means lower valuation because lower expectations due to the non-delivery of the stock. And you will see a huge actually decline in the stock price. And so that's where it's very dangerous for a lot of investors who actually get into the stock in a very bad setup. So as a global investor yourself, you have to be aware of this type of dynamics. And that's why you need to actually mind the setup of the stock you are entering in. So for that, you have to look at valuation, as we mentioned. You have to look at the business itself. Are there going to be any surprises that are not taken into account into the stock price? Or are there any type of litigation or issues that are pending that will be removed in the future and that are going to actually lift not only the valuation, but also the financials of the business? So that was, I would say, a very generic explanation of what the setup is, but this is a very fundamental concept in terms of investing. I'm seeing a lot of different investors today going into stocks with very bad setup just because the stock price has already risen. So actually in a bubble, this type of behavior is actually working pretty well because a lot of stocks are actually going up. But what happens when the bubbles pop or the bubbles slow down is that these stocks, they are never going to recover because from the get-go, so from the start, the setup was bad and it's very hard to actually overcome a bad setup and a bad position when you enter the stock. So we've seen that a lot in 2022, where a lot of stocks have never recovered, especially when the stocks have very weak fundamentals. So for you as an investor, you have to recognize that. You can try to actually chase stocks that are already successful. But the thing is that if they're already overvalued, they can continue to be overvalued for some time. But after, I would say, the end of a cycle, it will be very hard for them to recover. So as a global investors, so what I think is a reasonable way to approach stock investing is basically to look at companies where the setup is actually very favorable, meaning that there is a lot of pessimism into the stock and a lot of investors are not actually seeing the recovery in terms of fundamentals. So we are seeing that today with like United Health stocks or UNH. We are seeing that, I think to some extent with like PayPal. I think we're also seeing that a lot with Alibaba, where there's a lot of fear, a lot of pessimism. And so we've seen that play out because like at some point of time, like when the narrative changes, then the stock is actually getting a lot of bid and the stock price is actually increasing very well. So just for you to actually have a look at all these different setups, you have to pay attention to the second, I think, very sub concept within the setup, which is the narrative. So meaning what people are saying about the stock. So usually the narrative is driven by the media first, the retail community, or by hedge funds. So you have to understand what is the general consensus around the stock, and that will give you a pretty good understanding of what setups you are entering into and what is the main narrative into the stock and what is priced in. And so from there, you will be able to actually see what people expect and if you think that things are going to deliver, or I would say over-deliver against these expectations. So that's why investing is not very easy. So there are a lot of interpretation and a lot of art beyond the numbers, because a good setup is not actually seen into the numbers. Undervaluation doesn't mean it is by itself a good setup. We can see that with Intel. And overvaluation does not also mean I would say a bad setup. We have seen that with Amazon for years. So you need to actually get some nuance and basically be able to understand what is the narrative and what is your own thesis against this narrative and how the stock is going to over-deliver against expectations. So I think that this is all for today. This was a very quick introduction to this investing concept, which is the setup. I think this is one of the core pillar of understanding stock investing for a lot of different people. And this is why you have to basically not follow the news, but understand the psychology of other investors in the market. Because if you do not do that, it will be very difficult for you to understand if you have a good thesis and if it's the consensus, or if you're actually being a contrarian here. Another part of the setup you have to consider is to make the difference between the macro setup and the micro setup. So in terms of macro, where you need to understand in which cycle we are in the market, and if the market by itself is going to perform well or is going to decline. So this is very important, because sometimes like you are too much fixated on a single stock or like single stocks, and you just forget that the market itself is going to actually plunge, because either it's overvalued or you have a lot of headwinds for the markets going forward, like weak economy, for example, or like rising interest rates. And then you also have to look at the setup on the micro side. So that's what we've been discussing so far, meaning looking at the setup for a single stock, meaning that what are the expectations and how the stock is going to overperform or underperform these expectations. Also, as part of the setup discussions, that's one thing I want to address, and it's about chasing like stocks. So Basically, like we've seen that very recently, a lot of stocks gone up very quickly and very fast, and so I think this is a very big mistake to try to actually chase these stocks, because definitely you're going to be in a situation where you're in a very bad setup, meaning that the stocks has already run up, and the most logical follow-up of that is that it's going to retrace. And so you don't want to be in a position where you are in a stock actually late compared to everyone else, and that you're actually underwater -30 or -50% on the stock. So we've seen that very recently with stock like HIMS, with like Oscar, with like Bull, for example, where it has become very trendy and very topical on like Twitter, for example. A lot of people actually went into the stocks thinking that it's going to continue to rise, and just to end up in a situation where the whole market is at all-time high, but the investment is basically underwater -20 or -30%. So you have to be mindful of this. So if you're actually late to the party, just don't go, meaning that it's okay to actually miss these opportunities. You have to go early, or you just don't go, because once the stock has actually ran up, like, you are definitely in a very bad setup, and you don't want to be in this position altogether. So be reasonable, be mindful of this. This is another example of a bad setup, and I really think that as a global investors, you are able to actually recognize that. So that's it for today. And if you want to see other analysis like this about the Japan, Asia, or the US market, so feel free to subscribe to the channel and check my other videos, and see you in another one. Bye.